High-end financial advisor Centric Wealth boasts $4.9 billion in assets under advice. The company says for 2 years it's invested heavily in what it's calling the next generation approach to investment. To tell us exactly what that means, we're joined in Sydney by Ashley Owen, Centric Wealth's chairman of the Portfolio Construction and Asset Allocation Committee. Good to have you on board. Look, in my notes here I see this new approach is based on a real-world concept of risk management versus a mean variance method. What does that mean?
Well, thanks, John. The essence of it is that the GFC exposed the fact that the efficient market theory doesn't work. The rational expectations theory doesn't work. Markets are not normal. There is no normal. There's no new normal. There's no new normals in the financial markets. Financial markets lurch from bubble to bust, from crisis to crisis, from boom to bust all the time. So the idea that there's some sort of normal or standard deviation or Sharpe ratio just doesn't make any sense. So in the case of risk, what we do is we focus on risk in a very different way. If you go to a traditional financial advisor, you'll be given a whole bunch of stuff with nice, neat, straight lines and smooth curves. And if they think about risk at all, you're being thrown a number like a standard deviation number or a Sharpe ratio. Now, the problem with the Sharpe ratio is the Sharpe ratio is a very blunt tool. It doesn't tell you anything about risk. So in the case of risk, we actually spend a lot of time talking about the real risks to investors. Like, for example, what is a risk my portfolio won't last? What is a risk I'll run out of money? What is a risk I'll actually have to wait longer to retire? Or what is a risk I can't afford to buy my daughter a house in 5 years? So these are actually real live investor risks, which you don't get in traditional financial advice. So that's actually very different.
But I'm sure, Ashley, they were the questions that investors were asking of their advisors. What was the old model? What were the downfalls of some financial advice before or during the GFC?
Well, the downfall mainly rests on the very old Markowitz idea in 1952, which says that all markets are always fairly priced at all times. That means whatever the market is doing at the time, whether it's vastly overpriced or vastly underpriced, you'll just get your straight 60-40 portfolio, 80-30 portfolio, and that will just go into the market with very little regard for where we are in the cycle. Now, you and I know, most investors know that that's nonsense. There are times in every market cycle where fundamentally it's just not a good time to invest. Fundamentally things are overpriced. So in that case, we actually stand back and look at each market and work out how it's actually behaving and how it interacts with other markets, and recognising that markets actually do get overpriced. Now, that sort of stuff is actually common sense to you and I, but the fundamental basis of all financial advice around the world and in Australia has always been this efficient market theory. And the markets are not efficient. They are not normal.
No, so they don't feel very normal at the moment, do they? They're
exactly
volatile. This next generation model, I mean, it can't eliminate risks, but are you proposing less riskier investments? How do you come to a picture of what the investment should look like?
Not at all. Now, the idea of risk is very interesting because people regard risk in different ways. Now, today, the last week, we've had revolutions, we've had countries baring their teeth on nuclear arms, we've had all sorts of trade wars going on, and people get scared and say, well, that's all very hard, I'll go to cash. Now, when things go wrong, people then get scared and go to cash. Now, if people went to cash at the bottom of the market in 2009, they would have missed out on the 60, 80, 90% growth in the financial markets since then. Now, cash sounds very safe and sound, but out of the 110 years since Federation, 1900, 110 years, cash has been the best asset class for Australian investors in 2 of those years only, and they were 1928, 1929 and 1930. So Australians can go to war, massive world wars can come along, massive cold wars can develop, nuclear crises can develop, and through all of those, cash was never the best asset class. Generally speaking, shares, equities, well-chosen businesses are always going to provide over the long term better returns than cash.
Ashley, the government, the federal government, working through reforms called the Future of Financial Advice, which are likely to define what it means to act in a client's best interest. Is part of your program driven by that or in parallel to that?
Well, we were doing this I've been with Centric for about 1.5 years now, and the process is well underway then. We're in a good position because, unlike 95% of financial advisory firms on the market, we're actually not owned by a big bank or a big fund manager. So we exist not to flog product or flog platforms, which is what every other person in the market, almost every other person in the market does. So the process around financial advice in Centric is built around a professional service without regard for selling products. And that actually makes sense to you and I, but it's actually very unusual in this business. So we were on this path anyway before that process started to take place.
Thank you for updating us on the process. Ashley Owen from Centric Wealth, thank you for your time.
Thanks a lot.